Good afternoon, everybody. Thank you so much for joining us on this amazingly sunny day down here in London. As you'll see, we've got a full complement of speakers today, as we have Meena, Barsha and Alex all joining us to walk us through how we can prepare for the end of tax year. Without further ado, there's quite a lot to go through, as I'm sure you all know as well. So I will hand over and get us started.
Thanks, Julia. So today's webinar will be considering how you can prepare for your tax reporting. So those of you who attended our last webinar, we looked through the what if and how you could use the CGIX what if to help you with preparing for the last quarter and helping you maximise and optimise the most of your CGT for your investors. So this time round, what we're going to look at is how you can then use that or within CGIX to help you with your preparing for your reporting. So what CGT considerations do you need to take into account? That's going to be our first area that we're going to be looking at. One of the key things to remember when you're doing your reporting is your losses, making sure that any losses that your investors have incurred during the year are taken into account and are being offset against any gains that have also been made within the year. It's always important to remember that netting off your losses against any gains is something that you need to do when you're doing your CGT reporting. And as you all know, using CGIX will do this automatically for you. So that's a tick in the box for CGIX. But again, from an accounting point of view and from an investor's point of view, it's always good to make sure that your investors are aware that this is something that they need to make sure that they do and they consider. One of the other things is that investors always think that losses is a bad thing. It's also making sure that they do realise that any losses that are being made can be offset against their gains to reduce their overall CGT consideration. And that's not just for in-year losses, that's also the same for brought forward losses. So if you've got any investors who have declared brought forward losses from previous tax years, they can also be considered for this tax year's reporting. Again, there are orders and rules that they need to be considered in. And one of the key things is to make sure that even if your investor has made a loss in previous tax years, that the loss is declared. You can't use a loss if it hasn't been declared because the HMRC isn't aware that you've got this loss that can be used. So again, it's just making sure that your investors are aware of these rules and that you are doing all these things for them as part of their reporting, so that when they are looking at the final figure, they know that you've taken all of these things into account. So again, from a losses perspective, always net offsetting in-year losses first, and then using any brought forward losses to reduce that gain to the annual exemption, and that can be done as well. And again, all these things are done within CGIX automatically, and these are shown on your CGT report as well. As well as doing in-year losses and brought forward losses, one of the things that you should also remember and take into account is things like external losses. So it's not just losses that they're incurring within their investment portfolio. Have they made CGT losses outside of their investment portfolio that they might want to consider or offset for just this particular tax year because it's a one-off loss that they've made? Again, if that needs to be considered, you can use external losses and gains within CGIX to ensure that these are taken into account. But again, it's just making sure that your investor is aware that you are taking all these things into account when it comes to their reporting as well.
May I add to that?
Yeah.
I will just quickly add to that as well. When it comes to claiming losses, remember that you have until 4 years after the end of the tax year that the loss was incurred to claim it. So you have until Saturday, I think, to claim any losses that were made in the 2020 to 21 tax year. On Sunday, you will no longer be able to claim those losses.
And there's actually, I'm going to jump in today rather than saving questions to the end. There's a question coming through. Losses on connected
Oh yes. Go on. So so losses on connected persons. So as a reminder, in case anyone's not aware, so a connected person is essentially a family member typically. So it'll be a sibling, ancestor, or descendant. And if you make a transfer to a connected person, then and you make a loss on that transfer, remember that transfer takes place at market value. The amount of consideration that's actually paid is not taken into account, it's just the market value. If a loss is made on that transfer, then you can only offset that loss against gains made on transfers to the same connected person. So if you transfer to your brother, for example, and you make a loss on that transfer, you can only offset that loss against gains made on transfers to that same brother. Now, at the moment, obviously, you'll be aware CGIX doesn't currently do connected persons, but it's one of those things where you'll be aware and you'll have, obviously, you'll understand which ones of your clients are connected persons, and that is something for you to bear in mind when you speak to your clients, to advise them on which losses can be offset against which gains.
Thank you. Cool. So that then leads us into annual exemption. So again, following the rules when it comes to how and what your final figure is, we've looked at losses, so it's annual exemption. If your investor is looking to you to consider the annual exemption allowance, you need to make sure that all the rules are followed. So again, just like I said, that you can only use brought forward losses up until the annual exemption. Make sure that that's what is taken into account and that's what's been done. If your investor is not looking to you to use your annual exemption, you also need to make sure that that is clearly stated on your reporting. And again, within CGIX, we do both. So if your investor is looking for you to include your annual exemption, you do have the ability to get CGIX to do that automatically for your individual clients. And again, if your investor is looking for you to not include your annual exemption, then CGIX also has the provisions for you to switch that off within the system to ensure that the reports are accurate as per what your investors are looking for from you. Again, as the annual exemptions reduce, it becomes more and more important in order to make sure that any gains and any loss offsetting and all of that is done as accurately as possible, because you will have more clients and more investors needing to do reporting as the levels drop over the next year. It's not just a case of making sure that your client is aware, it's also making sure that they only have this to use once, and it's for that tax year only, and it's per person. So if they've got multiple investment portfolios, it's just making them aware that they are only using this value in one place only, or it's being considered when all their investments and all their gains are coming together. So again, it's just warning them, but also if they haven't used it, it's making sure that they are aware that if they haven't used it, it will be lost to them as well. So this is not like losses that can be carried forward. Annual exemption is only valid for the tax year that it's valid for, and if they haven't used it, it's then lost. So it's just, again, making sure and warning any new investors coming on board, or any investors who up until now may not have had to do a return or would not have been scrutinizing the reports because the annual exemption has been high up until now. But as I said, as the rates reduce, you've got more clients and more investors looking at reports because they are having to do a self-assessment. So it's just having these answers ready and being aware and making sure that you are making your end investors aware as well. The next one is volatile sales. So again, with volatile sales and timing, it's making sure that you are conscious about the 30-day rules and repurchasing. So it's making sure that if you've got disposals and purchases that take place over 2 tax years, especially with disposals so close to the end of the tax year, when advisors, clients are making disposals to make use of their losses, as we've just talked about, or make use of their annual exemption, trying to be tax tax efficient by doing bed and ISAs, as we talked about in our last What If webinar as well. These things can all take place quite close to the end of the tax year. It's then being aware that any repurchasing could have an adverse effect on this. And again, within CGIX, we do have a 30-day column on the CGT report that does warn any investors looking at their disposals that they are falling into a 30-day bucket, and they should be aware that if they are doing or thinking about doing a repurchase, it could have an effect on their overall gain or loss of the disposal that they've made. But these are all things to consider. And remembering that if you do a repurchase, that the disposal gains and losses will still need to be reported in the year that the disposal took place in, and not when the repurchase is done. So again, these are things that you need to consider and just be aware of, and also warn your clients and just make sure that they know that these are things that are going to affect their overall gain or loss and their overall CGT number as well. And as I said, these are all things that CGIX will help you consider. So whether you're looking at the CGT report within CGIX, you do have the option of the 30-day column. But if you are using the What If, we also have the volatile section as well that allows you to do the repurchases, but also gives you the ability to check what the impact of that repurchase would be before it's done as well. Interspousal transfers. So again, as those of you who attended the What If webinar, making use of interspousal transfers that are at a no gain, no loss basis allows you to be a bit more tax efficient. So for instance, if spouse one has used their annual exemption and hasn't got any gains, but then spouse two hasn't used their annual exemption, from a tax planning perspective, you may decide to do an interspousal transfer in order to then make the disposal in the second spouses to make use of their annual exemption or any losses that they may have made as well. With these things, you need to consider that the 30-day rule will come into play for all of this as well. But also remember that when an interspousal transfer takes place, it's done at cost basis, so that the receiver will inherit the cost of the original transaction, and it's not done at market value, but also that the date of the transfer is the actual date of the transfer, and therefore the 30-day does come into play. So just again, to be mindful that you are making sure that these things are being considered when you are looking to do tax planning and using interspousal transfers to do any of this, to again ensure that you are doing the best for your client. But it's then making sure that any reporting that needs to be done as part of this is also then done as accurately as possible, using the relevant rules to ensure that when your investor and clients are then doing their self-assessments, that they are reporting the correct CGT values that they need to as well.
I'll quickly just mention as well, remember that a few years ago the government changed the rules on the no gain no loss transfers for how long you could still claim them if the spouses separate. So there's a long-standing rule in CGT that the no gain no loss transfer between spouses is only permitted until the end of the tax year of separation, and then between separation and divorce it would be at market value because it'd be connected persons. However, remember that a few years ago that rule was changed, and so now it is until 3 years after the end of the tax year of separation that they are able to still benefit from the no gain no loss treatment.
Cool. So that was just an overview on the big things to consider from an investor's perspective. Other things to consider when doing your reporting, again, it's always when you are doing your tax year reporting at the end to your investor, it is a report that tells them what they've done over that whole particular tax year. And it may not just be that the investor is interested in anything that is technically classed as chargeable. Other things to consider, making sure that if you're not already doing so, qualifying corporate bonds, so QCBs are shown on your reporting so that, again, your investor is aware that they have made exempt gains and losses. Fine, they might not need to pay any CGT on it, but it gives them an overall picture of what the investor's investment portfolio looks like and what disposals they've made over the tax year. But it also gives them an idea of what they've still got to look forward to, or what they can do in the following tax years to come and the future tax years as well. And the same goes with government debt. So again, if they've invested in any government debt assets, these are reported separately. Again, it's just a case of providing that information to your end investor and making sure that they have as much information to hand as possible. The fact that they don't need to do any reporting on these is it's not always neither here nor there. It's a case of making your investor aware and trying to provide value add to your investor and giving them that information up front, so they're not having to chase you and say, can you give me a breakdown? You're already doing that for your investor ahead of time. That then moves on to deeply discounted securities, and it's a similar approach. So with deeply discounted securities, they do have different tax treatments, and they are taxed to income. So again, making sure that the investor knows that they have invested in or disposed in assets that have a different liability that they need to consider, and that at the end of the year, you are giving them that information that allows them to make decisions or report on these decisions that have been made throughout the tax year, can only benefit them and make it easier for them to do their reporting. And again, excluded index securities. So this came into play last year, and there was a new box on the HMRC form. Again, if you're using CGICs, all of these different asset classifications will get totaled up at the end of the CGT report separately. And again, it's to help your end investor understand what they've done throughout the year, understand the values that are being produced from the reports, and aid them to help them produce their self-assessments and make it easier for them to see where they need to fill in the boxes. And again, it's just a case of making them more aware and providing them with the information up front, as opposed to them coming to you at a later date, making a request as well. So for those of you who are already sending these types of disposals on assets and transactions to CGICs, as I said, we will already calculate these for your investors and put them on the CGT report separately. For those of you who are only sending us liable assets and liable disposals, maybe it's time to consider sending us a more holistic approach and giving us all your assets and disposals for the investor, to again give them an overall picture of what their investments look like as well. Following on from that, we move on to not your niche asset classifications, but things that are different. So offshore funds, again, always a hot topic. Reporting funds and non-reporting funds, again, from a CGT perspective, although not reported if you make any gains on non-reporting funds, they're classed to income, but any losses that are made on these assets can be used for CGT. So there are tweaks in the way that the rules are used and how they are governed from a CGT perspective. So again, providing and making sure that your investors and clients know what they've invested in and how their gains and losses in each of these different asset classes are being used, how they are being offset, and making sure that the correct rules are being used for those as well. VCTs, again, for your investors who are subscribing into these VCTs, are classed as exempt from CGT. And again, with the subscription rate as well, making sure that your investor knows that there is a threshold before they can have them to be liable. Again, making sure that all these are different asset classes that your investor is aware of that they are investing in, so that if they do need to do any reporting or they have any questions, they know what questions to ask, and how they can easily look at how the totals and the values are come up as well. Very similarly, EIS, again, if your investor is investing in these, again, it's just making sure that they are aware that there are different rules that govern these, and making sure that you are using the correct rules to benefit your investor with all of these as well. And then moving on to other asset types, so futures and options, derivatives, and cryptocurrencies. So again, all of these are available for you to do outside of CGIX, obviously, but we can also do them within CGIX as well. So for those of you not using futures and options within CGIX or derivatives, there are ways that you can report these within the system using existing functionality to, again, aid your investors and make sure that we can give you a more broader range of asset types and classifications, and ensure that we can help your investors going forward in terms of doing their reporting as possible. Finally, corporate actions. So making sure that, again, as we come to the end of the tax year, making sure that any clients who are taking part in any corporate actions have been processed correctly on your IMS system or in CGIX, to ensure that any reporting that needs to be done as part of them taking part in these corporate actions is done as accurately as possible. Typically, if there are any mergers, takeovers going through, if there's a cash element, making sure that the proceeds are received, and also ensuring that the proceeds and the transaction date of these are done in the correct tax year, to ensure that any liability is taken into account within the current tax year if it needs to be, or in the next tax year if that's the actual case. So making sure that any corporate actions are processed correctly in the correct tax year, especially, as I said, as we are close to the end of the tax year, to ensure that they are reported in the correct tax year. But also, if there is for instance, a stock element, making sure that stock element is processed correctly. If the fund manager chooses to then make a disposal in the new resulting security, that they have enough time to do so if they want to do it in the current tax year as well. So these are all things that need to be considered. And again, it's the same with bonus issues or splits. Although these are free from a corporate actions perspective, making sure that if they need to be processed, they are processed, because if there are any subsequent disposals that need to take place, that the dilution of the book cost is accurate, so that any gain or loss and any subsequent disposals is also then accurate as well. Again, with rights issues, if your clients are taking them up and then making subsequent disposals, just making sure that the book cost has been inflated to ensure that the transfer of these assets has come through correctly. And the same with bonds. So if there are any bonds that are due to be redeemed, making sure that they are redeemed when they need to be, so that they can all be correctly taken into account within the tax year it needs to be. Offshore funds and status changes, making sure again that if there have been any status changes on any assets throughout the year, that these have been processed correctly, whether the client has chosen to take on the original classification onto the new status, or whether they've done a deemed acquisition and disposal, that these have been reflected correctly on the investor's portfolio. Again, this will always ensure and make sure that any subsequent disposals that have taken place for any of these assets is going to be as accurately as possible, and therefore your investors' gain or loss at the end of the tax year and their overall CGT consideration is as accurate as it can be, based on all of the things that have taken place over the course of the tax year for that particular investor.
Yeah.
Yep.
In quickly again. Just if I should go back.
Yep.
Thank you. So just on the QCB's point, as we've been saying so far, the sale of a QCB is typically exempt from CGT. Well, it is exempt from CGT, but don't forget that there are special rules that come into play if the reason why the QCB is being disposed of, or the reason it was acquired, is because of a reorganization of capital of some kind, a takeover, whatever it might be, that involves either the acquisition of QCBs in place of stock, or the disposal of QCBs and the acquisition of stock in its place. When that happens, remember that the gain, if you like, is frozen, or the gain on the shares going into becoming a QCB is frozen, and it's held until the QCB itself is disposed of. The sale of the QCB remains exempt from CGT, but what it also does is it crystallizes the frozen held over gain. So fortunately, of course, CGIX is a long-standing rule, and CGIX does take it into account. So just make sure that if you've got anything like that coming up, bear in mind that if you do see a gain like that appears, that might be the reason why. It's always worth checking these things to make sure.
Thank you, Alex.
Thank you.
So again, from a reporting perspective and a CGIX and a CGT perspective, is how can you add value to your investors? Again, maximizing the liability through exemptions and loss offsetting. And again, just making all this information available to your investor so that they have it at hand, so that when they are doing their self-assessment, they have all the information readily available for them to do their reporting. So that kind of brings me to the end of my section, which is the CGT considerations. I'll now hand over to Mina to talk you through the income considerations.
Thank you, Varsha. So I'll take you through some of the income considerations that need to take place for checking your consolidated tax vouchers, and from that side of reporting angle, and just going through some of the queries and questions that we've had over the past couple of weeks, but also the past couple of months, following on from the December run that a lot of clients did for corporate reporting as well. I thought it was worthwhile just reiterating a certain things surrounding dividends and interest and just the terminology. Don't forget, gross payment does refer to gross payment. It is the gross total dividend or interest before any tax is being deducted. And the gross UK interest amount cannot be reduced by fees or commissions. And we got this question asked a number of times by a number of clients. So just to reiterate that, the gross is literally the gross. Don't include your fees or commissions in there. The HMRC manual does have a list of items that are deductible and what are not deductible for income tax purposes. So it's always worth referring to those as well. Your fees for providing financial services to clients are not deductible for UK income tax purposes either, and they shouldn't appear on your reports either. That brings us on to net payments. Net payments are any payments after the deduction of tax, and predominantly here we'll probably be looking at withholding tax that does take place. Net payments is also worth remembering that certain ADR stocks do attract a fee, and the net is always after tax. So again, not the ADR fee shouldn't be taken into consideration here either. For tax reporting purposes, the dividend voucher will generally tend to show the gross dividend, any tax credits if applicable, and then followed by the net amounts, and that's quite clearly labelled on our consolidated tax certificates. And the interest sections will tend to show you the gross interest earned, any tax withheld if there is any, and then any net amounts from there as well. The key considerations to take away from here is mainly withholding tax, and double check the withholding tax rates that are being applied, both to dividends and interest, especially as it can vary between countries as well, and making sure that the rate of tax for withholding is consistent for that particular country as well. Sometimes you get a slight variance going through, and that can cause a number of issues with clients as well, because they say, well, this stock was in this country and so was this one. Why both been got different withholding tax rates? And sometimes it's just been the way that the system has processed it. So it's definitely worth giving an eye out and a look out for any withholding taxes to make sure that dividends and interest that have been received from the same country all have the same rates applied to it as well. Also worth considering, and also a key consideration here, is making sure that you check payments. throughout the year as well, but also at the end of the year, you pay close attention to what's been reported on dividends and interest, because certain payments do have a tendency to change statuses from interest to dividends and vice versa, and that's quite common with unit trusts. So it's just being aware of when they have changed, that you're aware of the reasons why they've changed, so that you're able to explain it to your underlying investors as well, and just making sure that you've got all of that information readily available to hand. And if you're not expecting something to be seen as an interest or as a dividend, then obviously it needs to be questioned and raised accordingly. So that brings us on to unit trust payments and interest versus dividend. Again, I think it's worth just reiterating this point again. And we get a lot of questions asked about, unit trusts and the 60% rule, and, whether it should be treated as interest or dividend. And I thought it would just be a good time to have a look at those and just remind ourselves that, if a unit trust is 60% invested in interest-bearing securities, then it is to be treated as an interest. If it's less than 60%, then it is to be treated as a dividend. And the same rule applies to offshore funds, because they're all seen as authorized investment funds. And it's worth paying attention and looking at those as well, because again, like I said previously, they do have a habit of changing. And sometimes that changes because of the composite makeup of that fund has changed from going from a high interest bearing over 60%, and it's just dropped to under 60%. But having that clarification and ready to provide your investors is quite key, crucial to have to hand. There are implications, and the classification, like I said, does change annually. But also the other things to look out for in this area is REITs, because they can tend to pay more than one flavour of a dividend or an interest. And it's worth making sure that those have been segregated and are showing correctly on the reports, but also the split between the three is correct as well. To assist you with this, there is a security classification extract that is available in CGIX that can be run from the cedula, and that should help you review these classifications in making sure that not only is the payment treated correctly, but also that the classification for those securities is treated correctly for the item to appear correctly on the income tax schedules, and also to appear correctly on your consolidated tax certificates as well. That brings us on to income. So another quite common question we get asked is ex-date pay dates and things falling in and out of tax year. It's just worth remembering that ex-date is the date on or off when the security is traded and it's without dividend. Investors purchasing on or after this date will not receive the dividend, so it's worth noting that point as well. And the pay date is when the dividend is actually paid to the shareholder. So, it can sometimes be, there could be a gap difference between the ex-date and pay date, quite commonly known for ERIs, and that could trip in which tax year the actual payment will get reflected as well. So if you're not seeing certain payments in the tax year and you're thinking, well, why not, then just watch out for the ex-date pay date trap, because that can make a significant difference as to where it's going to appear as well. And we had a question on a particular corporate action that I'd like to highlight. There was a Hargreaves Lansdale query that came in. And the key point with this one was that the date of the capital distribution is determined by the entitlement to receive it, and not when it was actually received. And in this case, they said that the entitlement was on the 24th of March 2025. So you would think it would hit this tax year, but actually it's not due to pay until next tax year. So that's a corporate action of a capital distribution that, although will go potentially this side of the tax year, actually it's not scheduled to be reported until the following tax year. There is a little bit of leeway with this one because it's not fully determined whether it will pay just after the tax year, but we thought it'd be worth highlighting that there is this one that could fall into the trap quite quickly. And if you do have clients holding this, then it is worth just bearing that in mind. And especially when you're coming to running your reports, that there could be this one that just falls just outside of that little niche that I'm going to report in this tax year, or I'm going to report in the next tax year as well.
Just to amend it, I think you written right, but just to clarify, the because it's either the capital distribution, it's the date of entitlement or receipt, but for this particular one, what we're saying is the 24th of March, because that was the date when the shareholder became entitled to it, that would be the date of disposal when you're looking at a capital distribution. So make sure that you're looking at it carefully for your current year reporting. Thank you.
Thank you.
Thanks, Emily.
Well, I think the data that take place across several types of returns that were also returned at this time of year. And just here, I've just given a summary of the governmental returns from the BBSI perspective, the consolidated tax voucher, but also the CRS, FATCA, or Automatic Exchange of Information, AEOI, as number of anacrims it goes by. And what I'm trying to show here is that the data that goes through all three of these in terms that they're very quite similar. And what you do for one can kind of be replicated across the others, or if you fix one, it kind of transpires the data alignment across the other two returns as well. The governmental returns and the consolidated tax voucher are both based on tax year, so that's quite convenient. But OIE is calendar year based as well. Governmental return requires tax personal identification numbers, but in consolidated tax vouchers, we take name and addresses. But again, they still need to have similarities in there as well. And the CRS will take personal information such as names, addresses, and tax numbers as well. So having that all correct in one place means that you've got it correct across not just the governmental return, but also the consolidated tax voucher and also your CRS as well. In the governmental return, you generally tend to report interest paid and credited. So again, if you've got that correct in that return, then also that should kind of flow through into your consolidated tax voucher as well, into the gross interest, gross dividends, and gross or net PIDs as well. And a lot of that information, if you summed it up, should equal what's in your BBSI. But then if you have a look on the other side of CRS, that takes in the total gross interest paid and credited, and also the gross dividend paid and credited. And I get that the CRS is calendar year based, but technically if you added up the data from April to December, it should kind of match up to what you've got somewhere in the consolidated tax voucher as well. So there's a lot of synergy between all three returns. Appreciate the last one, the AEOI is on a calendar year basis, but the data that's required on all three and the level of data is quite similar, and they all do interact quite nicely with each other. So by correcting the data, don't just think of it as you're correcting the consolidated tax voucher, you're actually doing a bigger job in correcting it in for other places as well. So by doing that, you're also streamlining your compliance checks as well, and your control checks for making sure not just that the tax packs go out correctly to the clients, but also that your governmental returns on either sides are also correct as well. So that brings me on to reporting and how can we get ready for reporting. And in previous webinars, we've gone through several checklists that we say that are very beneficial in getting those reports ready. And if you utilize those again, then you should make those reports ready again. But also there's few little quirks and changes that have gone in this year, and the biggest one was the split total tax year. And I've just highlighted there some of the key changes that have gone in, and it's being able to split the gains between before and after 30th of October 24. Now, a lot of this is on our CGT reports already. So if you took our previous release, then that was already available and should be there for reporting for this tax year. And there's a previous webinar that goes through and showcases the CGT split summary totals as well that we can forward again, but we can also send out the reports as well. But just to give you a high level breakdown of the 4 new breakdowns that you will see as part of your CGT split total reports, you'll get the total chargeable gains from 30th of October 24, so that will be the total of any gains liable to CGT from 30th of October 24. You'll get a separate total chargeable gain for pre-30th of October 24, so that will total up any gains liable to CGT pre-30th of October 24, and then you'll get the same split for the gains liable to CGT pre and post as well. So that's the new break that's coming into the reports. Those that have taken the upgrades, that's there ready for this tax reporting, and that's quite crucial for investors to see that, because I believe it's reportable in the self-assessment, isn't it, Alex?
Yeah. I don't know if anyone watching the webinar has had a chance to play with the CGT tool that HMRC released last week or week before. The way it works is it assumes that all gains in the tax year took place before the budget, and then applies an adjustment to gains. It calculates an adjustment to for any gains that were made after the budget, or I should say from the budget rather, from the 30th of October. And in order to fill this out and make sure that the tax return is completed properly, the only way to do it is to have a total of your gains pre-budget and a total of your gains post-budget, so that it is then calculated correctly. Obviously, we were sort of working hard before we knew what the tool would look like, and happily we can say that it does absolutely work for the CGT tool that HMRC have published. So it is worth having a look, even just having a quick play with it for 5 minutes just to see how it works, because that is what your taxpaying clients are ultimately going to be doing.
Thank you. The final thing, I think got to one. Yeah. So the next one to look for is account closures and deceased account year-end reporting. So we all produce consolidated tax vouchers for accounts that close throughout the year. But it's one thing to bear in mind that some income and ERI payments might not have been paid necessarily at the time of closure. Again, it goes back to that scenario of ex date and pay dates. So those accounts that you have closed during the year, it's just worth maybe reviewing those when you come to the end of year reporting as well, just to make sure that, was there anything that was missed that potentially should have been reported to that investor, so that they get a complete picture, and then obviously rerun any of those reports where it's necessary to capture payments that were made after the closure date, or backdated amendments as well. So that's a good useful checkpoint to have as part of your tax year run, is just to cast your eyes over any closures that you've had in the last 12 months, and just to make sure that there's been no missed payments in the information that's been sent out to the investor. The other one that we've got is the deceased account and the split year reporting that's involved for deceased accounts. As you're aware, that you report transactions up to the date of death, and then you have a separate report that goes from date of death to the end of tax year. Again, it's worth ensuring that the payments and sales are being reported in the correct tax year, but also in the right part of the reports as well, whether it's like before death or after death, and that they're showing correctly. Again, this is where you'll get these things like ERI payments causing an overlap, where they could have gone X just before the date of death, but the payment should actually now be reflected onto the post-death report. So again, ones to look out for, and ones to add additional checks into your checklist for end of year reporting. There's been quite a few payments over the years especially over this year, where it has kind of moved quite drastically, and it's quite easy to get caught in that trap as well. The next thing that I just wanted to highlight was around testing of the OI and BBSI returns, and just a general comment around accrued interest tax reporting. Obviously, the BBSI and OI returns, they will go through that data validation and integrity check, just to make sure that they contain all the data that's in there. But we would strongly recommend that you run a test file, and you do test it against HMRC's portal, where they do allow you to run test files, just to make sure that everything is still in place, and those files are not going to get rejected as well. So we would recommend an additional pre-submission check, just to make sure that the BBSI and OI does go through correctly, and to see if you can get a test run done on HMRC. It would just help you get that final verification on the file formats and any data accuracies that need to take place just before you file your final returns as well. On the accrued interest tax reporting, I think just a point to mention here is that just make sure that they're actually reflected correctly on the tax reports, but also that they are on the tax reports. We've seen instances where they've just not shown up at all, and that's purely because sometimes the value date has been added in incorrectly, so it's just making it drop outside of the tax reporting period as well. So it's just one to watch out for, that if you are reporting accrued interest on your consolidated tax vouchers, then just make sure that you've got those showing correctly and reflecting correctly for the period that the return is being, or the period that you're being reported for.
I can't remember if you would go on to this, but also just to mention that don't just feed through accrued income amounts straight from whatever sort of financial system you might have into your tax reporting system, because often, for example, deeply discounted securities are an example of an area where they might have accrued interest included as an amount on the transaction voucher in your system, But remember that for UK tax purposes, accrued income is not allowable on transfers of deeply discounted securities. So you need to take it off, disapply it, and just put in the gross consideration when you're looking at transfers of deeply discounted securities.
Cool, thank you. Just a final point to say on the BPS side. If you're running the BPS side, CJX, then bear in mind that you can get two formats readable. The readable one will help you do all the validation checks and so forth, and so the unreadable one is the final one that goes to HMRC to help you with all the intricacies that surround the validations to do with BBSI and OI, like making sure that all the incomes are correct and like you've got all your participants set up correctly. There are 2 reports that are available as part of the HMRC extract area within CGX. You've got the income client exception report and you've got the income participation exception reports as well. But also ensure all your addresses are correct on the system as well, because any discrepancies on the addresses can cause issues with the returns as well. So just a couple of checkpoints just to bear in mind on those, and just to mention the 2 reports that you can utilize within CGX to help you get that data validity correct for BBSI and OI purposes. And finally, just wanted to bring to the forecourt again the foreign income gains. That is replacing the non-dom regime. And for those that have taken our latest release, 71380, you will now have access to the new FIG report, which allows for further action, which allows for all the other action points that have been identified above to take place. It will help you identify your clients that are impacted. It will identify assets that are continuously held by impacted clients between the dates, and help you compare the costs between those dates as well. It will help you to decide whether to rebase or not, and it will help you to decipher whether to crystallize foreign gains pre-April 25 or not. We would refer you to the previous webinar that took place on the 13th of February 25 for further details governing the FIG regime. But if you do have any further questions, then Alex is available to answer any questions surrounding the foreign income gains. But just to let you know that report is available. And for those that got upgraded recently, that is there now as part of an all clients report as well. So I don't know if you wanted to add anything else to do with the FIG regime, Alex?
I think I would recommend you watch those
Cool. And on that note, I would just like to finally say, if you would like to have your tax packs reviewed or audited before they do go out to investors, then we do offer a tax pack audit consultancy. So please do get in touch with us, and we can help you along with that process in validating and making sure that your tax packs are correct for the current calendar year, for the current tax year. And on that note, I will hand over to Julia, I think. Yeah, Julia.
Thank you very much, guys. And as always, if there are any questions that are burning in your minds at the moment that you'd like to pose to the panel that we've got today available to you, please put them through either on our chat sort of bottom right hand corner, or in the questions area as well. While I wait to see if anything comes through beyond the one that we've already answered, let me remind you that we have an event coming up in a couple of, actually before we go on to the event, that this is a CISI endorsed webinar. So for all of you listening today, this is your certificate is in the post or in the email by the end of this week, so that you can obviously have that and bank the hours. And the final thing that I wanted to remind you of is one of our upcoming events, which is an in-person breakfast with Michael Portillo. He'll be joining us on the 24th of April at the RAF Club. If you haven't already registered, I've put the link in the slide that you can see here, and we'll look forward to seeing you there. So I've had a quick look. There are no questions that have come through while I've been chatting away, in which case we will say thank you so much for joining us all today. If there are any questions, obviously Zendesk is very much available to our clients, but if not, please do get in touch with us and we'd be happy to help. Have a lovely afternoon. Thank you very much. Bye bye.